foremost, start that again. First and foremost, I'm going to be learning from you guys too, because we all bring different skill sets to the table. We decided to put this together just before the new year about putting a series together on passive real estate investing. Everybody in this crowd seems to either be doing it, interested in doing it, getting ready to do it. And I firmly believe that the next 2 to 3 generations in our country are going to be wealthy and in that category of wealth because of passive real estate investing. I think that syndications, passive investing it's fun. It's tedious and a lot of work, but at the same time, it's very rewarding. And this is not an individual sport. So the more people that you could put around you that you can trust, that you can reach out to, that have areas of expertise is important. Humility is also probably the biggest virtue in being a passive real estate investor. So don't be afraid to reach out, because you may be really good at due diligence, but you may not know a lot about the taxes, or you may be good at taxes, but you're not really sure about how the capital stack works. So what we're trying to do in this series is make it an open forum discussion, hands-on. This is not like a bachelor degree type, presentation. We want active conversation. If there's questions or somebody knows something that either I don't touch on or we don't touch on, please feel free to jump in. I'll be the first one to tell you that there's no stupid questions. It's just questions that don't get answered. I ask stupid questions all the time, and they're actually pretty good. So I don't call them stupid anymore. So if you got questions, please jump in. And, the discussion, this portion of the presentation really is meant to be maybe about 20, 25 minutes, if that. But then we want to open it up and have a really nice conversation on some of the things that are focused in this aspect or this part. We've done 4 parts, which we'll talk about when we get started. Today, we're going to focus on the capital stack. We're going to start getting into the fun part about how this money is put together, that your sponsors, your developers, your active partners that are out doing these things have to put this money together, and kind of how you just need to be sure you understand all aspects of it and how it's put together, so you can kind of understand whether or not it's done the right way, or that those questions are getting answered on your little checklist as you go through and you analyze deals for potential investment or partnership. So with that, I will go ahead and share my screen. And again, we are on part 5 of our presentation. It's great to have everybody out today. Thank you so much for coming. And, this is meant to, like Dave said, give back to what we know with others, so that they can go out and have the confidence and courage and excitement to do it. I was in the Navy for 20 years. I had a 4-star admiral that told me that we build the airplane 50,000 feet up. That's pretty cool. I mean, as long as it stays up. But yeah, don't be afraid to ask questions. Don't be afraid to get your feet wet, to get the process started in doing this. I know some of you folks mentioned that you're getting ready to do your first deal. Neil had mentioned that, and a couple other folks, but don't be afraid to get going. I mean, it's fun. Know what you need to know. And we've provided all of the previous parts via either YouTube or on Doug's page or our company page. So just make sure you get a chance to review those, and this one will be there too. And we've got 2 more left. So with that, we'll get started with part 5. Yeah, disclaimer, we got to put it out there, trust but verify always. We're going to talk about a lot of stuff. I'm not a licensed accountant. I'm not an attorney. I'm not anybody that's going to give you advice on taxes or give you guidance on how to stipulate legalities, because, you live in a different state. You have a different deal. I don't know how that's put together. So this is just really to say, hey, make sure that you do your homework, that what we say today is important, but talk to the professionals who are licensed and certified and are actually the ones that, can put their name out there to kind of, give you what you need. But we're going to talk a lot about good stuff today. Just make sure you do your homework if you need. And we're here to help. Happy to set up a call following this with me, Doug, or Dave at any time. Happy to talk to you more about some of the things we're getting at, and kind of have one-to-ones or offline stuff after we get done. This is our core group. kudos to Doug for really doing a fantastic job getting this out to his network, and Dave for our team. Dave said he's my right-hand man. He's actually my right hand, my left hand, my left leg, my right leg. So yeah, Dave's everything, even though he's Army and I'm Navy, we still get along really well. But yeah, he's been on board for about 2 years plus. And talk about looking for someone and finding a pearl in the rough there, because he's just taken on what we're doing and basically doing what I envisioned for someone in his position to do. Have fun with what he's doing, be empowered to do what he wants to do. And he's learning a ton, which is cool as well. So he's having fun with it as well. So that's good. I've been around doing this for about 15 years, off and on. Started active back in 2005. I built 2 new construction homes, had a blast doing that. Made about 60, 70K on those 2. I made about 150,000 on my primary residence. And it's about the 10-year point in my Navy career, decided to say, hey, I'm going to stay in and make this Navy thing a career, which is pretty smart because I've got 4 kids. And, I wouldn't be able to do it. I'd do it out staying in for 20. So it worked out pretty well. Got some time overseas in Italy. But about the 10-year mark, I decided to invest passively with some friends that were really just getting their businesses started. So I was kind of fronting them seed capital and getting a nice hefty return on my $250,000. But I was also getting this education. I was learning about analyzing performance and looking at, pitch decks and going through and looking at demographics and really getting into the nuts and bolts of it. So I did that for about 7 or 8 years. And then back in 2012, 2013, my family and I moved to our current location. Did my last 2 years in the Navy, retired, and we've been here since 2011. But I started my company, JD Investments, in 2013 in April, and over 10 years, we've invested on 30 projects, close to $40 million invested, with actual revenue around 8 million, with projections of another 25 million coming in on our active deals. So pretty exciting stuff. We're doing active development. We're doing ground up new construction, condo, apartment, mixed use. We're doing car wash. We're doing opportunity zone. And our target markets are really like the mid-Atlantic, DC, Maryland, Virginia, obviously, because I'm here. Dave's up in Ohio, so it's kind of our third headquarters. And then down south in the Southeast. And we talked a little bit about location in one of our previous presentations. Let me bring that up now. We'll get to that in a sec, but location is really important. I'd say it's probably a close second to the experience of the sponsor, which we covered in our second part. But if you got a solid sponsor partner and you got a kick-ass location and market, it's just a matter of whether or not the returns are appetizing to you, and the asset class is appetizing, which we've talked about. But if you got those 2 things, that's kind of, you're going in the right direction. And that's kind of what we look at when we're starting out a new partnership is, hey, how competent is this sponsor? How experienced? What asset classes have they done? They're getting it ready to do. And where's the locations they're at? So those are the big 2 for us. This purpose of this webinar is pretty straightforward. We want to make sure that we give back what we know, and we want to have a conversation with everybody that attends who can enjoy the opportunity to just share their information, share their knowledge, and learn a little bit something. Passive real estate investing, I think everybody knows what that is, but if you don't know what it is, it's basically you're bringing in capital and you're basically a silent partner. You're involved in really no active operations, management, ownership. You are a passive owner or a limited partner, potentially as part of a partnership structure, but you're not actually signing for recourse debt. You're not signing for title. You're not signing on any of that in the passive world. You're purely coming in. Syndication is probably the most common, but you can also be a passive active if you own an apartment and you got a property manager. You're a little more active there, but the property manager's doing the day-to-day. You're managing the books, and depending on how you have it structured, a little bit more active, but still in that kind of passive world. The pros and cons we talk about all the time with passive and active. It's really what you're comfortable with. I mean, if you're retired and you have the opportunity to go and buy property and spend time on that, and you want direct ownership, you want to control the property, that's great, and you're going to have most of the risk, but a lot of the reward. But if you want to sit back and really just say, hey, you know what, it's just like another investment where my money is the only thing that's really at risk. I've got a full-time job. I own a business. I have whatever things I do. I just don't have the time to go out and manage the day-to-day operations or the tenants or the management. I just want to be involved in the passive side. Syndication is probably the way to go. And the way things are going nowadays, I didn't realize it, but it is really a lot of people doing this, both on the capital raising side, like kind of what we do at JD Investments, on the active side, people raising money for their own deals, other groups that are standing up passive investments that are doing limited liability corporations and investing as LPs or co-GPs. There's a lot of it going on. And I didn't realize it, but yeah, there's a lot of people doing it and they're having a lot of good success. So, again, if you want to diversify, you want different types of investing, and we've talked about this before. Do you want passive cash flow month over month or quarter over quarter versus long-term capital gains? How does that work with my taxes? Again, we can have that conversation offline. But passive is really a great way to be involved, but don't have to be up front and stage and upfront personal with having all the liability and all of the challenges what a lot of sponsors have to take on. And they take on a lot of that risk because they take on most of the reward or a big portion of the reward. So I give them kudos on that. Guys, anything I'm missing here before we kick off today's part for this capital stack? Or anybody's got any questions, I can take a quick pause. All right, no questions asked, we will get it going. So we talked about our first 4 parts of the series. The first part was really important, putting your team together. If you want to watch that video, I suggest you do. Just talk about who you want to put around you. If you don't have time to watch a video, go and get Robert Kiyosaki's second Rich Dad Poor Dad book called his A Guide to Investing. He talks about it in depth on who you want to put around you on your team. And, to me, I wish Robert Kiyosaki would just already, build a university and teach anybody and everybody about all this stuff, because, people could be doing really well under his tutelage. I don't get paid from it at all. I just love what he's doing, and he's a great guy. And I got his game too, Cash Flow Quadrant, which is awesome, or Cash Flow.
Yeah, I was going to say, John, that it's almost like you must play Cash Flow for a while just to get, you gotta play it.
It's a lot of fun. I play with my kids. So if you got kids, Monopoly or Cash Flow, highly suggest you picking that up. It's a lot of fun. And kids like it. And now my kids are, hey, Dad, tell me a little bit more about what a Roth IRA is, or, hey, how can I invest in syndications if I've got $1,000 or $1,500? It's a lot of fun to be able to do that with your kids and share that with them as well. Part 2, we talked about the sponsor. Again, just talking about how a sponsor is important, what they bring to the table, what your red flags are. So again, you go through that. If you got questions, location on part 3 was huge. Why we like the locations that we look at, what you should be looking at when you look at a location. I'll give you an example. I love Charleston, South Carolina, because the weather's great, taxes are low, a lot of people are there. They're building and building and building. They just got ready to, they're getting ready to build a $3 billion EV plant, and right by the port. You got the second largest port on the East Coast. So, why do I like Charleston? Well, I think I just gave you 10 reasons there. It just makes so much sense to try to invest in that type of market. High barrier of entry, but definitely worth it if you can get into that type of market. But yeah, I could go into more on that, but we cover that part 3. Part 4, the types of asset classes, a lot of people like multifamily, makes sense. People need a house, and if they can't afford a mortgage or buy a home, they're going to probably rent. Multifamily is kind of a little bit stagnant right now with the way rent growths are and what inflation's doing to your cash, and how powerful your cash is to rent or buy or own. But it's still very important. People need a place to stay. Just got to look at the numbers and make sure you're crunching really hard, because we're not in the 3 to 4% interest rate world anymore. We're not in the 10 to 15% plus rent growth a year. That doesn't exist anymore. So just, make sure you do your homework, make sure you kind of understand that. And we'll get into that more in part 6 and 7 towards the end on the due diligence and doing your waterfall. Part 5 today, we're going to talk about, your capital stack, which is pretty exciting. And again, a lot of what we do with our company is one of the major components that you're pulling apart when you're looking at how the money's put together. And not only how the money's put together, how's the money put together? Where is it coming from? What are the assumptions of that money coming in? What are the impacts of the project from a cost perspective of that money? We'll talk a little bit more about that today. I'll take a pause. Do we have any questions before we get started? I saw one in the chat, but I don't know if that's something just posted. Okay. Kay, we'll hit your question, how to get in on a GP team. Wow, that's a good question. So you want to just kind of go through that and what you're kind of thinking there, because I'm reading how to get on the GP team, get the active side of the benefit from bonus depreciation. There's a lot of moving parts. So what in particular there can we help answer for you?
Right. So if I may,
Sure.
Yes, I am looking forward to being on a GP team just because of the high tax situation that we are currently in. But I've just realized after having a conversation with a CPA, which I've been interviewing CPAs, tax strategists, and kind of realized that as a passive investor, we are going to have a difficult time being able to utilize bonus depreciation, because even though it's a fantastic tool, we are limited. It isn't going to apply to us as much because I am not of an active investor. If I had known that before I sold off the last property in single family, that would have been great. So it's kind of learning after the fact, but I'd like to get into that so that I can seriously, it's all about mitigating my taxes at this point. It's to get that additional cash flow. So if we can figure out a way on how to move into that kind of position, and not just on the passive side, because passive is great, but I need to do something as far as being on that GP side so that I can grow it and actually have equity into a deal, have some ownership. So that seems to be that big gray area that is passed over by so many sponsors that is not readily available from what I'm discovering. And that's like a missing gap for me. Does that make sense?
Yeah, it does. I think the bonus depreciation I would treat separately. I think it sounds like you want that as an option or have available. As far as being on a GP team, there's the full bore, hey, I want to be a GP, I'm going to go buy an apartment building and I'm going to manage that project, right? So that's the full bore. If I got to go out and get a bank loan, I may have to send recourse on it. If I need to go out and find equity, if I can't bring it all on my own, how do I raise it? If I raise it, do I need to do a private placement since there's people coming in that are accredited? So there's a lot of moving parts there, right? If you want to work with a GP and be part of the GP team, then you got to find and I welcome anybody else to jump in, but just from my experience, you really got to either be a subsequent part of that capital amount that's coming in on the GP, and or you have to be in some sort of role working for the GP, whether you're a project manager or you're doing marketing or you're doing something that shows that you actually are part of the GP in some sort of way, shape, or form, and you're doing something to benefit or work with the GP. So that way it shows that you are being paid out as, or you're getting equity from the result of your work. So yeah, you just got to be able to show that from a compliance standpoint. Something to talk to your attorney about. Talk to your real estate attorney if you have one. If not, just find one that can give you a free consultation on it and just say, hey, I want to be part of a GP team. What are some of the liability issues that I got to worry about? On the GP team, if the GP is paying you capital as income, then it's going to be reported as income. If it's part of a deal, it kind of gets a little bit gray because, if the GP is owning promote, then that can be considered revenue, which could be income. But if it's over a year or so, it could be captured as long-term capital gains. So there's a lot of gray areas there. It depends on how the CPAs for those firms structure it. But at the end of the day, if you want to be part of the GP team, you can own it, run with it, partner with others and do it. Or you'd have to come on as, some sort of hire or part of the team where you're, either being compensated and or you're taking a piece of their promote for work you're doing. And you can invest with them as well. You could bring in a portion of it. We invest as a co-GP a lot with a lot of our sponsors, but we're bringing in 80 to 90% of the money. So we've got a big chunk of that GP piece, that co-GP piece that we invest on. Anybody want to kind of?
Yeah, I'd love to add to that, because that's a fantastic question, John. That's really one of the beginner questions that are really great, because it's like, how do I get started? It's daunting at first. Like, you see an apartment building and you're like, how on earth does anyone buy one of those? You have to buy that yourself? No, not at all. I think you were hitting on the right topics too, John. That really it comes down to, how do you add value to a partner that you want to work with, and essentially it's deals, dollars, operations, or swinging a hammer somehow. Like, so if you have like a value add construction, like construction skill set, or construction management skill set, operational leasing, operational skill set, or the deals or the dollars. So if you can source deals, you're going to be relevant. Also, if you learn how to raise capital. So it really also depends on what is your personality type. What do you want to do? If you have a sales personality like me, you'd love the capital raising, makes a lot of sense. If you like to geek out on the spreadsheets and the underwriting, that's maybe a deals person. And then operations, there's also another personality type that loves just running the project. So and then of course the construction side of things also. So there's a bunch of different side of it there. So that's basically my advice always, is just find a way to add value to that team in one of those lanes.
Yeah, and I know, hey, Brandon, welcome. I'm glad you came on. Brandon's also raising money, I know, on some projects, and he's kind of been like the money raiser, but also as part of the co-GP. So Brandon, I don't know if you heard the question, but Kay had a great question about how to maybe try to team up with a GP to be part of the team, but more in kind of like a working element. And what are some of the stipulations? What are some of the things that you have available to be able to participate on that? So anything to share on that from your aspect, Brandon?
Yeah, sure. And I want to apologize for kind of coming in there late.
No, that's all right, man. Glad you came.
But I heard the back end of it, and I think what you said there, John, is definitely accurate, and that you have to have a substantive role. And it sounds like you pretty well listed out the various roles on a GP team. So whether you're the underwriter, whether you're focusing on capital raising, investor management, and engagement, all pieces that are critical in this. Typically, what I share with people that's a great way to sort of get into it is to focus on the value that you bring. I think that was mentioned as well, focusing pretty heavily on your piece of it. There are a lot of teams that might have that piece filled, and that's okay. But you just need to find someone that you trust, but that needs, if underwriting is your thing, then there are a lot of people that don't like spreadsheets, and so you can kind of tell them, hey, this is my thing. I've done this for X number of years. I understand which levers to pull in order to make the deal work, or to see why it doesn't work. So you really have to kind of make your value proposition clear, and then that becomes sort of your piece of it. I think nowadays it's a little easier to find groups. It is still hard to find a trustworthy group when one that's kind of worth their salt. So that's what I would say is a way to get into it. Nowadays on LinkedIn or various platforms, you can find people whose title or description it is their syndicator or their lead GP, whatever it is. And so you can probably start there if that's what you want. But it is definitely a gargantuan task. I think that's something that John mentioned. It's a huge task. And it's just, I tell people, partner up, find someone that has done it and that has a need, and try and fill that need. Other than that, I definitely think that starting off as an LP is a great way to go about it.
And I want to add one other thing here that was kind of implicit in what, John, you were saying, and definitely what Brandon's saying. Network as much as you can physically tolerate. The more people you meet, the faster you'll get to clarity on where you want to be.
Yeah, all great points. And I'll put a shameless plug in for Brandon. He's got a fantastic podcast, and so he's another fantastic resource if you guys want to see how he pulls apart deals and hits specific topics when he brings his guests on. So definitely check out what Brandon's doing. He's been a co-GP, a GP, and an LP on a lot of deals. So I'm glad he's on today, and I know he's going to add some value on the conversation.
Thanks, John.
Yeah, you're welcome. And so let's any other questions? If not, we can get this ball rolling. So, and this should say part 5, I apologize. There we go, now it does. So what is the capital stack? I think everybody hears that and they're like, well, I guess that's the money. Yeah, it is, but it really is the pieces of the puzzle that are needed that are brought in at various levels of capital amounts and percentages and leverage that makes up how a deal is funded. So I'm sure that the biggest one everybody knows or has heard of is debt. Nowadays it's getting pretty expensive for debt. I think, I'd see average debt on deals range between low 6s to maybe as high as low 9s right now. It's crazy that, with the 525 basis point increase to interest rates over the last 9 months, it's just skyrocketed debt. And so it's getting more expensive for debt, but it's still the majority of the time the largest part of the capital stack. So you're usually see debt in 2 forms, most likely just one, but sometimes you'll see it as primary and secondary debt. So your primary debt is usually a bank loan. There's insurance groups, and I'll list them here. There's different types of debt lenders, but most of the time the primary debt's going to be a bank. Most of the time, depending on the parameters and the terms, it's going to be recourse, which is basically saying, hey, if you can't pay back this debt and you can't get us what we need as far as our terms on the debt, we're going to come and take the property. And oh, by the way, if the property does not is not valued at what your loan amount is, then we can come after you personally and make up the difference. So that's a recourse loan. And a lot of folks are able to get non-recourse, but in a way, I kind of like the sponsor being on the hook with the bank and having recourse, because that makes sure that everything is going to go as planned and that they're willing to take on that significant risk. So that's probably the biggest risk between passive and active in my book when it comes to the capital stack is recourse. The liability of being personally liable, your business being liable for that debt when you sign on. Secondary could be like a mezz loan or some sort of junior debt that is basically below or is going to be behind the primary loan. The challenge there is sometimes primary lenders won't allow a secondary loan on the property because they don't want to have another debt lender on there behind them. They want to have full control of both the property and the liability and the personal guarantees. So you really don't see that very often. And then the secondary debt, is going to want probably a personal guarantee as well. And for that, they're willing to take a second position behind the primary lender. And so they're okay with that. But most of the time, it's the primary lender that's going to make that difficult to bring in mezzanine financing or a second loan or second lender. And you can see that too when you have a single family property. If you take out a home equity loan, there's got to be significant equity in there, or a home equity line of credit, and the primary lender also has to agree to that or at least be on board. Those are the different types. You got bank, which on a commercial real estate project, most of the banks that you're seeing are regional banks or local area state banks. You're not going to see like a Wells Fargo typically fund a development project in a small market. You're going to see smaller banks. Some of them, like in my area, are Sandy Spring Bank, John Marshall. Down south, you've got Quadrille, Fahey Bank up in Ohio. There's different types of commercial banks that will come in and bring in that primary debt. Insurance groups, a lot of times you get these insurance companies that want to give they're giving a 4 or 5% return to their investors, and they're loaning the money out at 7 or 8%. So they make some profit. And I don't want to get into this too much, but the Fed is going to basically set the interest rate. It used to be LIBOR, now it's called SOFR. And that SOFR rate is basically the base rate that the Fed sets. And then on top of that, the lender's going to set their cap rate or their rate cap or their percentage, their addition to that to see how they make money. So when you see 5.25 or 6% at the Fed level, that's just the SOFR rate. The bank's then gonna add a percentage based on what they want to make on profit. So that's why you see these 7, 8, 9% loans. And then there's a lot of groups right now that are doing debt funds, a lot of preferred equity groups that have kind of raised pref in the past are now doing debt funds. So a lot of groups are now loaning money out as debt funds at 6, 7, 8%, and are competing with and or are even better than the banks right now. So that's another thing that I'm starting to see a lot more of is debt funds. And then lastly is you could have private investors that come in. More so I've been seeing on taking land down, because most of the cost in a new development project or new construction isn't construction, the vertical. So a lot of times, and we've done this before, we've come in with the entire amount to purchase the land. We have first position, we get all the benefits, but then when we convert over to a construction loan, we lose that, that luxury and that first position to the bank, because now they're bringing in the larger set of capital. So those are the typical groups. Guys, anything else I'm missing or you've seen from where you sit? Anybody in general, if you guys want to add anything, and otherwise we'll go to the next section. And we'll talk a little bit more about analyzing debt on the next slide and how that looks and how you kind of looking for some key things. I'll also show you a slide from one of our projects on the pro forma on assumptions and show you where you see some of those things we'll talk about. The next piece that, I'm sorry, go ahead.
Have you ever worked directly with like Walker & Dunlop, direct agency lenders, things of that nature? Fannie, Freddie?
Yeah, I mean, a lot of times those groups like Cushman and JOL and Walker Dunlop, they're going to go out and they're going to basically source that for you. So you're going to bring them on and hire them as a broker. They're going to basically have probably a exclusive to go out and find your debt and or your equity. So they'll get paid a fee for that if they can bring in. So
yeah, my understanding is they're a direct agency lender for Fannie and Freddie, Walker & Dunlop. They're not a broker.
Is there a direct lender? Well, that's a good question. I won't say I know the answer to it. I know that direct
Well, that's
lender.
what they claimed to me when I spoke with them. So we can get them fraud. Yeah.
No, yeah, I don't know. That's a good question. If they're actually going to provide the debt, I mean, has anybody else heard of that or worked with Walker Dunlop? Yeah, we could look into that a little bit more, Neil, and talk offline. But most of the time, most of those groups I know are going out and sourcing that for you. They're going out and buying the actual groups, the banks, the funds. Like, we've got a project down in Charlotte, and my sponsor sends me a list. Well, he did. We finally were starting to get the debt lenders to come in, but we were getting a list from JLL, Jones Lang LaSalle, hundreds of debt lenders that have kind of put in from that broker, and they were telling us, what they found in the deal, why they liked it, if they were passing, and then the next steps, which is really helpful when you've got a broker going out and hunting for the debt on a deal. The next part of the stack is typically the equity. The equity is usually going to be preferred equity or common or general equity. The preferred equity sits higher in the stack, and we'll show you that in a second. From the regular common equity, but it will sit behind the debt lender or lenders. So the debt lender is usually going to get paid monthly on their debt servicing. They're either going to be charging you interest only for a period of time, then it's going to be an amortized payment with a little bit of interest and principal. After you make your payments to the debt lender, the next group that's on the list for the capital stack is the preferred equity. Preferred equity usually gets between a 12 to 15% a year return, but they're not bringing in obviously as much as the bank is. The bank, and we'll show you this in a minute, bank's usually going to bring in about 50 to 75% of your capital stack. And then your pref equity will probably bring in around 15, 20%. It just depends. So a little less money or less money than the bank, getting a little bit more of a return, not as much as the last one, which we'll talk about, which is the common equity or the general equity, but they're batting second or third in the batting order behind the debt lender or lenders. They're next to be paid after the bank gets their principal back. So when we get into the due diligence section, which is the next one, and we start talking about what you're looking at in an operating agreement, you want to be able to understand what's the priority of payback well, what's the priority of distribution of capital coming out of a deal? The first one getting paid back is loans, any loans. There's the major loans, there could be secondary or member loans. Those are all typically getting paid back first. Second is going to probably be that pref lender if they're, or pref equity piece if they're in the deal. They're going to probably get back their principal and potentially could get their 12 to 15% a year before you see a return of your capital or where your waterfall starts as a common equity, which is the last piece, which we'll talk about, is your general common equity. And that's where you get LPs or high net worth individuals that are coming in as part of an LP group. And those LPs will make up the general equity to be brought into a project. So just like when you're going to go out and get a loan on your home, the bank's going to say, hey, Neil, you want a loan, we'll give you 70%, but you got to bring in the other 30%. Well, when you're going out and getting $100 million, you have a $100 million project and the bank says, yeah, we'll give you 70 million, but you've got to come up with the other 30 million. That's where you get into that equity. And how do you slice that up? Okay, well, I'm going to get 15 million or 20 million from pref at 12%. And then I'm going to go and get the remaining 10 or $8 million from a couple of LPs or a co-GP that comes in with me as the sponsor, as part of my team to bring in my portion. The general partner in a partnership structure is the managing member. The GP is going to be typically the sponsor, right? They're going to wear a couple of hats. The hat that manages the project, runs the project, oversees the project, does the day-to-day is the sponsor hat, okay? The GP hat, the general partner hat, is the hat they wear that is part of the partnership structure, that is part of what comes into the project in the form of equity. So the general partner is going to be bringing in some money, that better be bringing in some money, typically 5 to 10% of the equity they need. And so they'll get an equity percentage membership as part of the structure of the equity partnership, but they'll have managing partner powers. They'll be able to make key decisions. And then the other groups that come in with them will be the limited partners. And that's typically where you're going to come in as a passive investor, typically as a limited partner. And a limited partner, again, is either made up of individuals, it's made up of LLCs, it's made up of a group that comes in and either brings in the, let's say 90 or 85% of the common equity that's needed. And then the sponsor will come in under the GP hat with the remaining, let's say 10 to 15% of the common equity needed. So let me show you a basic structure here. So basic structure, debt comes in, let's say it's a $100 million project. You know, the debt's going to come in, let's say for 60 to 75%. So they're going to come in for about 60 to $75 million on the project. Okay. And then let's say after the debt, you got to go out and hunt for pref equity that you want to bring in, typically institutional, again, insurance groups, family offices, pension funds, REITs are all considered preferred equity. And they're going to be coming in again at like that 10 to 15% return range and bringing in about 10 to 30% of the remaining slug of money that's needed for the project. Okay. So now we're at about 70 to maybe 85% of the total money. The last group that's going to come in is the green slice, which is your general common equity, which is made up of those limited partners, those groups that are going to come in to bring in the last slug of money that's needed for the project. Now you see these arrows here. Let's start on the left side. The risk goes up higher on the money that's sitting at these different layers. So the bank has the least amount of risk. They have the most amount of money in the deal. So they get the property, they get a personal guarantee, they get all of the, benefits of being in that majority stake position. And then they're also going to be getting paid an interest rate every month, right? So they're making money on their profit. They're making money on their loan to have the least amount of risk. And they're batting first in the batting order. All right. So that's risk goes from bottom to top, more risk as you go up higher. These guys up here obviously have the biggest risk, but then the rate of return or the profit or the reward is higher as you go up the rung to the top, where the common equity is making anywhere from 20 to 40% return on their money. It just depends on the deal. Could be a little lower if you're in a cash flow project with an existing asset, but typically, you know, that rate of return is higher at the top. So the biggest chunk of money gets the smallest return, and the smallest amount of money gets the biggest chunk of return. Does that make sense? And then on the right side, you've got this priority of payment. So obviously the bank down here, and I know this is kind of weird looking, but the tip of the arrow is the best. The bank is typically going to get the priority of payout. So when you look at your operating agreement, you know, you should see in the distribution section that the bank's getting back their money first, then the pref equity, then the common equity is going to get their waterfall, which we'll talk about more in the next one. I'm going to take a pause there because I may have kind of wrapped out a lot of different things there, and pause for some questions or some comments if anybody wants to jump in.
I have a quick question, I guess. So for the preferred equity slice, can you maybe elaborate on how, you know, it's not uncommon for the pref equity to have better terms on a deal, or to be able to negotiate maybe better terms on a deal?
Yeah, that's a good question, Brandon, especially now with the way the banks are kind of lining up. You know, pref equity groups, like I said, are pretty much institutional in nature. We are seeing a lot of general equity groups now stand up pref equity funds. You know, when we invest on a project with JID Investments, we come in as a limited partner or a co-general partner typically, and we invest on one project. We call that a single purpose vehicle or single purpose entity, SPV, SPE. So any deal we're going to invest on is going to be where that money goes. The most we've invested on in one project or investment was 2, but we just kept it under the same investment, and it was with the same sponsor, same location, same asset class. But 90% of the time, we usually come in and invest directly on one project. So everybody knows where their money's going. It's structured for that. With a pref equity group, that they typically will stand up a fund, and their monies will be farmed out to different projects. Just like if you were to invest with a sponsor that's got a fund, and you know, let's say they're a multifamily fund that invests in 100 projects, well, your 100,000 is going to go all over the place, right? You don't know necessarily where you'll know where it's going, but they're going to sprinkle your money all around. Pref equity terms. For the investor that's going to be bringing in the money, it could be a public institution like a REIT or an insurance company. But if it's private and it's got only accredited investors, let's say under a 506C unregistered security, you know, they can negotiate their terms, you know, to benefit the return mainly, and then the priority of payout. Yeah, I mean, typical terms are a lump sum percentage. I don't really see pref equity getting paid monthly. It's usually paid on an annualized basis. There is the potential of deferred until construction's over. Sometimes they'll come in just for the construction phase, but the terms are pretty clear cut. I mean, hey, I'm giving you this amount of money to get paid this return each year, and I'm exiting at, you know, closeout, sale of building, recapitalization, or refinance. And, you know, pref equity groups will take a fee. If they're licensed, they'll take a fee off of the investor's returns. And if they're not licensed, then they'll probably take a portion from a promote structure that they put together. But they still have to adhere unless they're a large group, like you know, I'll give you an example. There's a company called Equity High Investment. They're an institutional group. They've got licensed brokers. They got licensed folks, so they can charge investors. I'm not licensed. I don't charge my investors, so I typically take what's a promote structure after my investors receive their portion of the waterfall. So these pref equity groups are probably doing the same thing, where they're going to set up a structure where their investors are paid their advertised returns after they bring in distributions, and then they're able to get their portion of the promote. So does that make sense, Brandon?
Yeah, that makes sense. Thanks.
Sure. Any other questions on that? All right, and then I'm going to show you one that's a little more complex. We call this a dual tiered capital stack structure. Same scenario. You've got your bank coming in for 60 to 75%. Pref equity in this case, you'll see a lot of sponsors offer different classes of investment on their deals. So rather than going out to a preferred equity group, they'll offer their investors, they'll offer on their deal, their sponsors will offer on their deal an LP position or a preferred equity position, which basically means, hey, we're going to pay Class A investors that come in with this class of equity, this Class A equity, a 10% or 9% preferred return. And those investors are going to get that preferred return, and they're going to have priority, just like I showed you on this one, as being behind the debt. So basically, the debt's getting paid first, and then any investors that come in under a Class A are going to get a preferred return, and they're going to be behind the debt. So they're batting second. But they won't be able to share in any profit split. So you're just basically getting a 8 to 10%, let's say, preferred return, and you're getting your money after the debt. That's another way a sponsor will raise capital, prioritize the distribution to that first level equity tier, and not have to go out to an institutional group. And if you remember what I said, what Brandon asked, that pref equity on the institutional is usually making about 10 to 15. So if I can go out and raise that same level on this dual tier capital stack structure at 8 to 10, I'm saving myself, 2 to 7% or 2 to 5% a year on my money. So most of the time you'll see that on a smaller raise, or if you've got a group that's been doing this for a while and they've got, a couple of thousand investors they go out to that like that. And some people like that. They say, hey, I don't want to have as much risk. I want to get a straight up return. I want to bat second in the batting order, and I want to wash my hands clear of this so that I don't have to take on any more risk. The Class B obviously gets a preferred return and or gets a portion of the profit split. So again, just like I said here on the left side, higher risk, higher reward. So these guys are saying, hey, I'll take a pref, bat second. These guys are saying, I'll take a pref. I'm willing to bat third and take on more risk. I want to get a little bit more of that profit split once everybody's paid out and there's remaining money in your waterfall to then divvy it out, by percentage of how the sponsor's going to split the remaining profits. And then the last class, the Class C, you'll typically see is that GP piece where the sponsor comes in, they're going to invest the remaining 5 to 10% of the capital. They're going to bat last, and they're going to get a return on investment on their capital. Now, don't get confused with this. The sponsor is going to make a promote as well. That's going to be that revenue they make, that ultimate profit they make when everything is paid. That doesn't include their Class C piece. The Class C piece is, hey, I invested 10 or 5% as the GP, as the Class C. I'm going to get a return on that based on the waterfall and based on the distribution schedule. And then at that point, when all of this money here is paid out, whatever's left is going to go to the sponsor under that promote structure. That's their profit. They deserve it. They paid the bank back. They serviced the debt. They paid the preferred equity back. They paid the common equity back and their returns. They paid a return on their money now, which is fair. And then they get their promote. So that's kind of a little bit more of a, complex capital stack. Most of the ones we see are the basics, but, I've been seeing, and you'll see deals that are broken out like this. Does anybody have any questions? Or does anybody else want to share a capital stack that they may have seen that's a little bit different than kind of what I've laid out? Okay. We're not going to jump to part 6 yet, but that'll be our next presentation. But I want to jump to this slide, and I want to focus on kind of some of these terms that you're going to see. And if I'm missing any or I don't mention something properly, please feel free to jump in. A lot of times, what you want to look at on your sponsor's pro forma is something that's called the debt service coverage ratio, and your DSCR basically is, what percentage is the bank being serviced on their debt from what I'm bringing in from cash flow and net operating income. And so you want to see a DSCR and that is above 1, and preferably between like 1.2 to 1.5, because what you're saying in that instance is you're saying at a 1.5, let's say, I'm able to cover the debt service or the payment to the loan, right? That's the 1 of the 1.5. And then I have 0.5 remaining for net operating income, working capital, money to be distributed out to my my investors or as part of my payouts. A lot of banks are going to want to see at least a 1.2 DSCR. They want to know that they've got their 1 point, that 1 before the point, whatever, covered. So if you see a deal that's got a 0.95 or a 1.05, that's a red flag. You want to definitely make sure you talk to your sponsor about why their DSCR is so low. A lot of times banks won't even give you a loan until you can show on your pro forma 1.25 or better on your DSCR. So that's important. Another thing that's very important is your fixed versus your floating rate. And I think that we're seeing this now in the environment. A lot of sponsors that have floating rate debt that came in at 3 or 4% are now paying 7 or 8%. And I can tell you firsthand on some of our projects that depletes your cash reserves pretty quickly when you're paying 2 to 3 times more on your mortgage because of that 525 basis point we just saw that the Fed's been going through over the last 9 to 12 months. A lot of groups get a fixed debt a loan, but the challenges on fixed debt is that you may have a prepayment penalty. You may have to be in on that loan for a minimum period of time. You may have to get to a point where you're amortized, where, hey, we're going to give you interest only for the first 2 years, but then you're going to have a full year of amortized at 1 year before you can dispose of this debt. So that's another thing. So they both have pros and cons. A fixed rate loan is probably very beneficial right now if you can get one, because if you're going to be in a deal for, let's say, 5 to 7 years and it's an existing asset, it's multifamily, you're going to just go in and improve property management. You're going to get the rents up and you're going to bring in quality tenants to get the occupancy up, let's say from 70 at a 7 cap to 90 at a 5 cap. Then fixed rate debt makes all of the what's the word I'm looking for? It makes sense. Makes all the sense in the world to do. If you're going to be on a project that's let's say 3 years, it's development, new construction, and I'm going to sell it all out as either a fully stabilized asset or condos or townhouses, floating rate gives you a little more flexibility, no prepayment penalties, but then you got to play with the rate jumps when they change. So that's important. I'm going to jump to the 4th bullet, which I should have put as the 3rd, because you could actually have a floating rate, but you can actually ask for a rate cap. And what we're seeing a lot of now is a lot of sponsors are paying for upfront a rate cap. So just like if you were going to pay buy your loan rate down by putting in more closing. A lot of sponsors are doing that, and they want to lock in at a rate or a rate cap that says, hey, we can't go above that if the rates go higher. So if you've got a sponsor that's got a 7% floating with a rate cap, then that's not going to go above 7, and they've paid for that. A lot of really smart sponsors, these are brilliant sponsors, are actually building that in, and they're taking that off of their acquisition price. So instead of paying $10 million for a property, maybe they're going to pay 8.5, and they're going to have a little extra capital to put towards that rate cap. So that way their debt servicing is lower, especially in this environment. And another thing to add too is, every deal you look at right now, I don't care if it's a 2, a 4, or a 10-year project, it should have some sort of refinance built into it, because the rates are going to come down. They're not going to come back down to 3 or 4. Those days I think are over, but they're going to come down maybe 5, 5.5. So you're going to see a lot of groups refinance. And so that should be built in. I mean, I don't know. I mean, unless just to be really conservative, and that's fine. Somebody will build out a 10-year or 7-year pro forma with a 7.5% interest rate to show conservatively, hey, we're still going to underwrite, hit our numbers. But my response to that is, that's great. I appreciate it. Now show me something on a refi so I can at least get an idea of what could happen and what's your plan to do that. We usually call that either permanent or refinance loan that comes in, and that's the more fixed, that's the more core plus asset that's now fully stabilized and executing as a retail property, pumping out cash flow. And that's why you're going to want to have the lowest rate so that you can enjoy more of the distributions and the revenue coming from the rents. Going back up to the third one, recourse versus non-recourse. We talked about that. As a sponsor, if you want non-recourse, there are lenders out there, but you're going to get probably a higher rate. We'll talk about the sixth one down there, leverage versus unleveraged. You're going to probably get less leverage debt, but it's out there a little less more now because of what rates are doing and the way people view commercial real estate and loans. Your entry and exit cap. So that's really important. Very, very important, especially now. Rule of thumb is you buy at a high cap rate and you sell at a low cap rate. Well, the problem right now is interest rates are so high that valuations are just out to lunch. About a year ago, maybe a year and a half ago, cap rates were ridiculous, 3.5 to 4.5. And again, you're basically saying that your asset is really valued well when you have a lower cap rate. It's just a measure between your net operating income, your expenses. That basically tells a buyer how well your property is basically pumping out cash. So you want to go in at a higher cap rate because those are the properties that are typically struggling. And when you get it to 90, 95% occupancy, you got full rents coming in, you got great property management, you're in a B or an A class property, then that cap rate's going to be really, really, really low and valued well. With interest rates going up, there's not a lot of stuff trading right now. I've seen cap rates 5.5 to 6%, multifamily, mixed use 6.5, and a high cap rate is not a good thing because you're taking a lot of value off the table. So what's the predicament buyers are having, or owners right now are having? They have a floating rate, all right, interest rates are skyrocketing. They've got a loan term that's going to be due probably, let's say, in the next 6 to 12 months. They've got a property that's worth 30% less than what they valued it at as a 4.5 cap, and there's no buyers right now. That's a problem. That's a big problem. So be aware of that as you start reading and doing research. Is always looking at, hey, what'd you come in at? What was your cap rate when you bought? What's your rents at? Do those numbers, because if you're getting into a deal that kind of, is in that situation, you want to steer clear. And
John, I would love to hear your intake on what is your feeling for and I think it's primarily a multifamily problem, but the number of these bridge loans that are in trouble are bank related or private fund related. It seems the private funds are much more willing to be aggressive about forcing sale, whereas the banks may be less motivated to actually force a bad outcome because it basically comes back on them. And my sense is how much extend and pretend is going on, I guess, is what I'm driving at.
Yeah, bridge loans are, if it's a really experienced sponsor, then the bridge loan makes sense. I mean, and like we had a deal where, we were supposed to start construction a year ago, but when the rates started coming up, we had problems getting financing. So we took a bridge to buy the dirt with a private investor in my company. And then my company brought in some capital, sponsor brought in some capital, take the loan down because we had a closing date and we couldn't keep pushing that. So the seller wanted to get out of it. They wanted to sell the property, and we started permitting, we started plans and development. So we had money in the deal. So we took the land down with a bridge loan to give us, a full year to be able to get, financing for the project. So in that situation, it makes sense. But I mean, if you've got, let's say your debt to equity or your debt to equity ratio is, 85%, meaning that your debt, you only have about 15% of wiggle room between what you owe on the loan and the valuation of the property. It's not a lot of things you can pull as far as levers because there's not a lot of spread on that, so a lot of people aren't going to come in and put up money, or there's not going to be a bank that comes in to refinance because it's just not going to squirt out enough money to give them a return. There's a lot of risk. So bridge loans, I mean, a lot of people are doing them right now to try to put life support on there. But if you get into a deal that's got a bridge loan, you're going to want to make sure there's a significant amount of equity on there at a very conservative exit and cap rate before you decide you want to invest on that. I still think that there are deals to be done that, if you need to get a bridge for 6 to 12 months, it makes sense. Banks are starting to come back. I actually read, I don't know if anybody else did, about 2 weeks ago, the Fed has sent guidance out to regional banks and local banks to work with their borrowers, And I mean, we've got a deal in DC where we were actually able to negotiate a fixed rate right at SOFR, which is unheard of. So the bank is just very impressed with the sponsor's track record, the ability of the sponsor to show, hey, we believe in this project, we know it's going to come back. And so we went from a 7 3/4 rate SOFR and the bank interest down to 5% fixed for 12 months. That's amazing. But the caveat to that is once we start popping out positive cash flow, we're at about 75% occupancy. We're going to pay all the cash flow to the bank. That's the risk that they're taking to be able to take the cash flow. So we're okay with that, to get to a 90 to 95%, turn it around. Hopefully interest rates come down and we can sell it at a 5 cap. That's the goal.
Yeah, I would agree. And I think depending on who you ask, by 2025, the rate environment will be tremendously better, depending on how things go. But a very interesting next couple of years for sure.
Yeah, and I think, everybody says we may see another 1/4%. We could, but nobody thought we'd see 3% inflation last month. I'll be honest.
Yeah.
I never thought we would see it. And I know core is a little higher, but 3%, I was like, there's no way. 4 is the new norm.
Yeah.
But so
Yeah,
that's good.
any way you slice it, I think we're close to done with rate hikes. Anyway,
I agree. And I think that 24 is going to be a stabilized year, and it may even come down a bit. Why? Because it's a presidential election. So I think you'll see rates coming down. And I've got another really cool article, maybe I could send out to the group, that talks about that, and I don't want to get into this too much, but the problems that the government is having right now and the central bank's having, because they're getting in a really bad pigeonhole with these interest rates continuing going up, where it's supposed to trigger an illiquid environment, but it's actually creating a liquid environment. So there's more cash available, but with these interest rates going up, they're crushing the private sector, which in turn is going to cause more of a problem on long-term debt. It can't be sustained. It's a great article, and I'm like, holy crap, like this is really, really good. So I'll see if I could share that with the group.
Yeah, please do. That sounds incredible.
Yeah. And just real quick, and we'll finish out, leverage percentages, that goes back to that 60 to 75% from the bank. If you get more of that 60%, that means you've got to go out and get more of that more expensive money in equity at that 40%. However, your debt servicing is lower. You're not paying as much to the bank, but you are paying more in equity, which is always going to be at a higher, percentage of return. So that's kind of a double-edged sword. Everybody likes 75, 80% leverage debt, but you got to be careful on that because that means the bank's got more control of that property in a larger chunk. So it's got to be balanced. I usually like to see 70, 75%. That's usually pretty good. Nowadays, you're seeing 50 to 60. 60 is high given the environment. Levered versus unlevered returns. A levered return is basically what your return looks like when you forecast the bank and the percentage of the bank and what the debt servicing is. So that number should always be higher than the unlevered returns. If it isn't, you get into a scenario called negative leverage, which basically means that, the bank is actually causing you to have a lower return, which should never be the case because the bank is always the cheapest money. So if you see a sponsor that's got negative leverage, that should raise the flag to say, well, what are your terms in your bank? How high is your interest rate? What should getting into a lot of the things we mentioned prior, because negative leverage doesn't make any sense. I mean, you're almost getting a negative return on your capital. Yield on cost is another big one. You're seeing right now around a lot of groups want to see a yield on cost around 6.5 or better. Some of them are going down to 6.25, but that's basically what's the percentage of revenue based on the operating costs of the project. If you get below 6, a lot of people aren't going to come in on that, a lot of banks. So just keep that in your mind. You know, you could do some research on your own if you want to get into it a little bit more, but that's a question you should ask your sponsors. Yeah, what's your yield on cost for your bank? And if you hear 6 or 5.5, that's not a good factor. You want to be at 6.5 or better. Member loans, a lot of times you'll see member loans where the sponsor will go out and get a loan from an individual. That member loan will then become the second in the batting order to get paid back. And a lot of groups do that for 2 reasons. One is that you know, they need some extra cash, and for the second reason, they don't want to go out and have to put out a capital call. So in turn, they'll go out and get a member loan, or they'll you know, borrow money off of their company to bring in additional capital for a project. And I'm not talking like, you know, tens or hundreds of millions of dollars. I'm talking a couple of $100,000 or $1 million just for working capital, because interest rates went up and mortgage rates are high, or mortgage costs are higher, or because of inflation and, you know, management costs have gone up higher than underwriting. But again, you want to make sure you ask these questions, because the underwriting has to support a spread after payment of all the people that are ahead of you in the stack, to give you comfort that there's going to still be a lot of meat on that bone to pay you back your money and your profits and your returns. So that's what these are why you want to ask all these questions and put them out. And then the last thing is, I mentioned it before, you know, interest only versus P&I and amortization schedule. Amortization schedules are usually set for commercial real estate deals for 20 to 30 years, especially if it's a refinance. But yeah, you want to see something where, you know, it's interest only for maybe 3 years with 2 years of you know, fixed, and an extension of 1 year. We call it a 3-2-1. You'll see that on a term sheet. So just want to make sure you're aware of that. That's all I got. I'm sorry, I know I went a little over, but you know, when you get into stuff, it's fun and you share a lot. But want to just make sure you guys got our contact information. I'll leave that up for a few minutes, and then I want to show you a pro forma, so you kind of, you know, when you get a pitch deck, which is, you know, slides of the project that go over kind of just some of the generic information. You should also be getting the pro forma from your sponsor, which breaks out their P&L and their balance sheets and all of the details and the guts of the deal. So there's our contact information, you know, where you can find Dave and I, and our website, LinkedIn stuff. And then Doug, I'm sorry, I don't have your website or Facebook. I apologize.
It's okay. It's not a problem. It's not that pretty anyway. I did it myself, so it's not that great.
Nah, no worries.
It's quite okay.
Make sure you guys can connect with Doug. Doug is in a ton of, you know, networking groups and knows a lot of very smart people, and just a master marketer. So yeah, definitely connect with Doug. Some of these projects that you see on your screen are actually finished and they're leasing. But you know, we've got a project here on the left in Frederick, Maryland, 189 apartments. We've got 22 already leased up in 1 month on the market, which is awesome. This one's down in DC. This is kind of my problem child, but it's working out, and we're hoping to get out of that one by the end of the year. About 75% occupied. And then this one's down in Atlanta, Midtown Atlanta, 91 large condo style apartments. We've got about 15 of those leased up, and beautiful views to downtown Atlanta. So would love to talk to you more if you want to hear about JID, but this is not really intended for us to give you a marketing pitch on our company. It's more of just sharing. Don't be afraid to go out and get this stuff going. Watch our other videos, take the plunge. So start small if you want to get into some crowdfunding at 1,000 or 5,000 on the syndication. But like I said, if you could spread out some capital and do this, I know we've got people on this call that are doing it for a living now and are probably loving it. So get on you. If you want to stick around a few minutes, I want to show you a model, a pro forma model, if you'd like to see. This is a company we work with that we're doing a deal with them down in Charleston. You know, this is their assumptions tab, and this is a great slide or tab on their pro forma. I mean, you got everything on here from, you know, our returns and the project level returns to the fees, you know, closing dates. We've got the square footage of the property, the percentages, where they're located, what the values are. You've got, they do a great job on base case, downside and upside case for their the rents. So you can see here that their rents are predicated on about a 3% increase, which is good. And that's what you typically are going to see. Their vacancy percentages, some other income they're going to earn in utilities or laundry. Here's a square footage for each of their floor plans, what they're going to get priced. So this is really cool. I mean, this is awesome because you could do a lot of good analysis from this and taking what they have and measuring up against what comps that are out there are like type properties. Because, the first thing you do, and we're going to get into this in the due diligence part, is you want to pull the bullshit flag to see if the sponsor's out to lunch. But if the sponsor's, hopefully perfect and everything looks good, now you want to measure it up against the market to make sure that the market's showing for what they're showing is identical. Property management fees, pretty standard, about 3 to 7%, what you see, maybe even 10 sometimes, but I like 5%. Expense growth, what their operating expenses are going to go up year over year. Parking, Now, when I get down here, this is cool. This is a mixed use project. And right now we're looking at letters of intent, which basically initial offers on a commercial space. And we underwrote $72 a square foot, but right now we're seeing about $75 to $80 a square foot, which is awesome. Triple net, if you don't know what triple net is, it's pretty easy. Triple net means the landlord pays for pretty much just the taxes or maybe the insurance, and then the tenant pays for everything else. So that's pretty cool. And that's something you'll look at, broker commission. Here's your debt info. So, look at this rate. We came in at an 8.35%. It actually was a 7.91, but we underwrote an 8.35% rate. Here's our cap rates. So, very conservative, 5.5% cap rate on sale and on the refi, which is great. I like that. 5% on their refi rate with SOFR and the spread. SOFR at 3, it's coming down about 2% from where it's at right now. And then here's your DSC, a little low, but that's going in. So as we start to rent up and we start getting tenants, that should go up to about 1.3, 1.5, which is really cool. And then some of these other tabs, like you got sources, where they're getting their money from. Here's the debt, 65% bank loan, LP equity, limited partner. And there's no pref on this, which is cool. So it goes right to the LP. And then there's the GP, which is 10% of what they're raising on the LP side. So 31.5% is coming in as LP equity, and then the rest is coming in of the GP. So it's nice is the LP is batting second. So as soon as the debt gets paid back, next up is the LP. A couple other things on here, it's the budget. You can break this out and see what the costs are. A couple of other things. This is nice. This shows us, hey, this is what down here, I'll show you here. This is kind of what the LP is getting as far as cash flow on that $6.8 million investment. So here's all our cash flow. Here's all of the return. And then here's our profit, a return of capital. And then we get a big check at the end when we get done with the project for our profits. So this is really cool. Waterfall shows you how the waterfall works. Really cool. Depreciation. They actually have a depreciation scale. So this is what we're going to be paying. We're going to get in depreciation each year, which is cool. So you know what you're going into your depreciation year over year for taxes. And this is project level. So you just got to compute from what your percentages is of an LP of what you're going to be making on this. And that's what you this is down of each of the properties and what they're going to be making each year. Look how detailed this is. This is really, really good. These guys do a fantastic job. Here's the debt servicing, the commercial income. We do have some mixed use units. So this is what we're getting on the rents, year over year rents, bump up, price per square foot, year cost and averages for months total over the year, bump ups. I mean, this is really, really cool stuff. Rent rolls, what they're going to be paying market rate now versus when they're fixed up. So on this project, we're going to see about a $700 to $1,000 increase across the four floor plans of this project to show fantastic increases towards getting us where we want to be on our cash flow. getting that market rate rent up, getting the occupancies up, getting kick-ass property management. So really interesting stuff. I mean, if you're an analysis person and you like this stuff, this type of performance is exactly what you want to see. So just want to share that with you guys before we kick off. I know I talked a lot. I apologize if it was too much, but I'm going to open the floor. Please, 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 at least ask one question, just so that, you know, you feel, you know, you can get that addressed. But we will have follow-ons if you guys want to jump on a call, set up a one-to-one. I have a Calendly appointment. Calendly, you can set up a time with me if you'd like. And the next part will be, let's see here, due diligence. So let me put that slide up. And that'll be fun, again, because due diligence is really, you know, hey, yeah, I've got to do my market rate due diligence, but I've also got to do all of this kind of other stuff we've been talking about due diligence with a lot of the bank stuff. But then I got to pull out the legal documents. I got to make sure that, you know, what this guy or gal developer said is actually in the legal documents, is in the operating agreement, is in the private placement documentation. You know, they said it's a 3-year deal, but why does the operating agreement say 5-year? So that's where you either get an attorney to review that, but we're going to teach you in this section really the you know, the cliff notes. And what I mean by that is the stuff to really pay attention to, even though there's other things you want to make sure you know about. But if you've got an attorney, you do the cliff notes, let the attorney do the full 200-page document. All right, guys. So I think Kay had another question, a couple questions. So Kay, shoot, I want to hear you. I don't want to read.
I think at this point, I'm a little, just to be honest, I'm a little overwhelmed.
Okay.
Because it comes at me really fast. That's why I'm asking for the video replay, because
Yeah, for sure.
I'm trying to take notes and listen, and I'm leaving myself little clues on what this note means. Which is, to me, it's a little scary because I actually did just invest in a deal, and it's been a couple of weeks, hasn't closed yet, which makes me extra nervous, but they seem to be a very strong company. It's not the end all, but it just makes me extra nervous because these are some points that you brought up that I was unaware of to consider. So maybe I hadn't done enough of the background, the analysis and that sort of thing. So got a lot more work to do, but I'm glad I didn't invest a whole lot to risk a whole lot and, you know, getting my feet wet. So
So number one, I'm happy you invested. That's awesome. So don't feel like, you know, oh, I should have knew all this stuff. I'm like, nah, that's fine. You did your homework. You should feel confident. This is really just intended for you to just add to your checklist, right? And that's why we did the recording, because yeah, we want you to watch this and try to absorb it and listen and ask questions. But yeah, go back and listen to it again so you can take those notes. You can look, you know, you can freeze frame and look up some of those terms we went over in that last slide. And it's just, you know, you're going to get better and better as you do these, because you know, you're going to learn more, and I'm learning more every day, every deal we do. I'm learning more and more, and it just gets added to my list so I can share it with others and learn from it. You know, in the Navy, and Dave can attest, and anybody else that's been in the military, a lot of our, you know, governing procedures and stuff, like when I was in my plane flying, a lot of the procedures, unfortunately, were written in blood, because we learned from a lot of folks that unfortunately had mishaps. 99% of them, most of them survived, but some didn't. But those procedures went into our manuals to learn from those procedures, learn from those situations, just like this. So one of the things, you know, you can think of is with this group you invested is, hey, can I get a copy of the commitment letter from the bank just to see that and make sure I understand the terms, and also to make sure I know that the closing is going to happen at those dates you stipulated. And it's not a trust thing. Don't feel like you're putting somebody out of their way when your money is being invested with them. I don't take it personally. You know, you shouldn't be worried about asking those questions. It's your money. You worked hard for it. And so you should be able to ask any question you want, but I would ask for that commitment letter. And if they don't give it to you or they shy away from that, then, you know, you need to pull harder on that string.
Understood, and I'm definitely gonna do that.
Yeah, and then when you get the commitment letter, go through
Yeah,
it.
and this
look
is
at some of those things we talked about.
unrecorded, it's all recorded. You can see that I'm like, yeah, I'm as green as it's gonna get, but I'm red right now because this is totally embarrassing to find out that I'm probably screwed up somewhere.
No, I think you'll
But,
still
you
be
know,
fine.
I'm just gonna keep laughing at myself because this isn't gonna be the first time. It's probably not gonna be, I'm sure it's not gonna be the last, but I'm learning. It's gonna be an expensive education if it screws up.
I
Anyone,
think,
anyone who hasn't screwed up, raise your hand.
and honestly, because you're here, I bet you have done way more due diligence than a lot of other passive investors out there. So I would not go crazy. But also that's why I always recommend when you're investing with somebody, you invest the minimum amount until you kind of like test them out, see how it goes, and kind of go from there. So invest with multiple sponsors, invest in multiple projects, so you spread your risk.
I totally agree with that philosophy, and I was gonna ask if that would be, because it's on the top of my mind as far as investing in different groups to figure out, okay, does a particular team work best for me? And then if it does, and I do get my returns as expected, you know, I feel good about that and the team's growing, then it's okay to then invest more on the next deal that comes.
Yeah, and look, I think that's very smart. I'm looking forward to the story you tell us about how you made 18 or 20% a year on this deal, which I know is going to happen for you. And I think that one of the things that Paulette brought up, which is great, is you can go out to these sponsors, and if you're an accredited investor, they'll send you their deals, you know, and you can mix and match these deals and look at each one. So go and talk to Omar Khan at Boardwalk Wealth. Go talk to Brian Briscoe. Go talk to Whitney Sewell. Go talk to these guys that are doing this stuff, and get on their investor list so that they can send you their pitch decks and start, you know, comparing them. See what you see in one and what you don't see in the other one, and maybe that's something to pull the thread on or ask. You know, I just started investing personally with my self-directed IRA and my wife's self-directed IRA. And this is outside of my company because I have a lot invested through my company and my projects. So I said to myself, man, I do this for a living. I'm going to go out and use my wife's and my self-directed IRA. She, of course, gave me the green light. I didn't do it behind her back. And got into a really neat asset class. And but I had my interview questions for each of these sponsors. I interviewed about 12 sponsors, and I had all of these different questions. Who's your property management company? How many deals have you done? What's your full cycle return versus projected? You know, all of these different questions. And when I was done interviewing those 12 groups, I had my top 3, and I went with my top 1 because I felt like, hey, these are great returns. I like their process. I like what they're doing. And when you go through that and you look at their deals and they answer every question and they get back to you within 24 to 48 hours, ask a couple of people that you know in your network group, hey, have you invested with this group? Ask them for 3 to 5 referrals of investors. It's one thing I did, and I got green light from all 3 that I talked to, and I felt really good about it. So do your homework. You know, most of the stuff you can your eyes will bleed if you go through and do the level of research, but eventually, you know, take the plunge. You're going to learn.
Yeah, I can say first and foremost, it took me almost a week to read through my first operating agreement, the PPM. I went through every single line of every page to understand, to make sure it was consistent, it made sense, and it did make sense, but there was some areas that were gray out, where you have to really understand that structure and how you get paid and when you get paid. And that does create a bit of confusion. So you got to really pay attention to that. But what wasn't spelled out was when when they do a refinance, are you still owning shares of that project, or are you done? I mean, you get your capital back, are you done, or you still own? I mean,
Depends on the deal. I actually, that's a real red flag for me if the refinance takes the investor out. I personally don't like that. It's just not really great because wait a minute, you're going to use my money to buy this building, then when you refinance, you're going to keep the property. That's just me, my personal opinion on that. So it does depend on the deal. But generally, I'd say general rule, and I'd love your John's take on this. Generally, you're staying in the deal.
Yeah, I mean, look, I'm always going to have the primary exit with our company, and Dave can attest and jump in. But at the end of the day, we've got our primary exit, but we've got 3 to 4 other exits too. So if I'm doing a development deal, and we're doing this right now, we do a development deal for apartments or mixed use with apartments. The primary exit's going to be develop it, build it, get it stabilized, and then we're going to exit. That's what I'm advertising. Now, I may say, hey, there could be an opportunity for us to stay in this longer if A, the sponsor wants us to stay in longer and offers it to us, or B, that, you know, I can get you back all of your investment money, or let's say that 3-year development and build deal and get it stabilized. And now I'm going to give you back all of your investment money. We're going to take that profit you made over 3 to 4 years. We're going to put that in as cash flow now as your principal. How awesome is that? You don't have to pay taxes on that because you didn't liquidate. Now you're making cash flow and profits off of long-term capital gains. And then you're also getting depreciation write-offs on your profit. And then when you finally exit 10 or 20 years from now, yeah, you'll have recapture gain, but you're going to have all that cash flow on profit. You're getting 100% return, and you're going to have capital gains down the road. You can give that to your kids. I mean, man, that's awesome. So but that's an option. Not everybody's going to want to do that, right? Some people are going to say, no, I want to be out in 3 years, I want my money, I want my profits, pay my gains, and we'll do another one together. It just depends, but that's the primary. And, you know, if it's a refinance inside of that 3-year, or they're going to take us out at some point inside that 3-year. Yeah, I'm like, Doug, I want to know that. And I want to know why they're taking us out. If they're getting me my advertised returns and taking me out at that point, and I'm happy, I don't care if they take me out. Okay, bird in the hand, I'm out early, and, you know, great. I'm happy I was able to help. Let's do the next one. If they're kicking me out and I made crappier returns than they projected, yeah, I'm probably gonna have a bad taste in my mouth and maybe not do another deal with those guys.
By the way, Kai, now I for sure know that you have done way more due diligence than any other passive.
Well, you know, you really can. And there's techniques, and for that, I'm sure you've got fantastic processes and checklists. We all do. And, you know, sharing of information is key, but invest with people, you know, I mentioned those names, those people I mentioned, you know, I know them. I know they're good operators. They know how to make money. And, you know, I don't get paid anything for that. I don't want to. I just know that they're good people. But there's others out there.
Wait a minute, John, there's an opportunity. We're going to send Brian Briscoe an invoice for marketing.
That's right.
He's like, what? Wait a minute.
May have to ask him to come and pitch one of his projects. Yeah.
That's right.
Maybe we could do that as part. Oh, now we got a part 8. So
that's right. Part 8.
Series. Yeah. That's actually a good idea. Maybe we'll do that. Part 8 will be a sponsor comes out and talks. Let's put that on the books.
That would be fun. Yeah, we should.
So I'll stay on here till 10 o'clock tonight. I love talking to you guys and want to do that, but I know you guys are busy. Happy to stay on. For part 6, one of the things I want to do is with the operating agreement, I also want to show one of our PPMs. And again, just show you kind of like Kay said, where you want to focus. About 70%, correct me if I'm wrong, guys, but about 70% is the risk, because basically it's your way of saying, hey, this is supposed to go like this, but these are all the things that could happen, which may be a challenge. Like, who the hell knew COVID was coming, you know? So that's just really 70% of the PPM is about risk. But yeah, Neil, I want you to do your first deal, man. Go for it. You know, if you need resources from us in this group, let us know. If you guys need good referrals, if you listen to some of our previous videos on this or parts, we had Dan Lyon out, who's a real estate attorney, business attorney, Mike Torrey,